Welcome back, everyone. Greg Diamond here, back from a week break with the family, and I was looking over. I was watching everything that was happening in the markets. What I found interesting, which I'll start off with, is everyone was calling this a crash. This goes to show you what happens when you have very, very little volatility for a long time, and then you have a market correction. Or a market move, and then the whole world freaks out. But I'm just going to jump right into it in this week's Diamonds Edge video, and I just want to show you, again, just a little bit of the overreaction here. All right, so this was back in March and April. S&P dropped almost 6%. It was a similar reaction, like, oh my God, the world's ending, and we definitely saw that last week. And this drop, just a hair over 9.6%. So, I don't understand the crash, explanation for what's happening. This isn't to say that actually getting to this over the next few weeks, we're going to have more volatility. But the fact that people are calling this a crash, I found a little strange. So this week I want to go. I'm just going to stay within this chart. I just want to show you a few things, and I outlined 3 specific scenarios to 10 stock trader subscribers this morning. I'm going to save that for those paying subscribers, but I just want to show you kind of the short-term setup of what I'm looking here in the S&P 500. All right. So first, I want you to see this. RSI's oversold, as is the composite index, and you often see this near at least short-term bottoms. This starts to slope up even as the RSI makes a new low. Now, this isn't to say that we couldn't see the S&P trade lower, right? So maybe we have another pop up, then get another swing down, and then get a much bigger bounce. All right. What would that look like on LA Waves terms? Well, this is what it would look like. 1, 2, 3, 4, 5. All right, and then you get the bounce. All right. Also, what I want to show you around here is what's called the Fibonacci confluence zone. Now, most people just go like this. They put the high down to the low, and then they start to measure. There's nothing wrong with that, but what you'll find is that the market will respond to different levels. Okay, so check this out. As I'll look for gaps. So the gap there up top there. There's a gap right here. I'll measure that, and then I'll just go from top to another gap. And so what you tend to find is, and I'm going to highlight this here, is Fibonacci confluence zones start to come together. Well, what does that mean? It means you start to see similar, or I look for tighter correlations or tighter levels within these Fibonacci measurements. All right. So rather than just one level that you're looking at, it's a range. And obviously, when looking at LA Wave, this helps you to say, you know what? If this happens, 1, 2, 3, 4, 5, it's happening into this Fibonacci confluence zone, within this red box, that should mark the low, especially if we consider what's happening with the RSI and the composite index. All right. Now let's take a look at a different alternative. All right. And this is all in the short term here, after the crash that we saw last week. Okay. But to me, it just means, that we have a short-term low with a rally coming. So instead of something like this, where it's 1, 2, 3, 4, 5 down, it was an ABC correction. All right, off of this larger move. All right, and that still holds within the Fibonacci confluence zone, and then we rally. So it will look something like this. All right, and now we have it could either just keep going up, or we have a pullback. It makes a higher low, and then we have this rally into, call it late August, early September. So those are the short-term factors I'm looking at in the S&P 500. Again, the RSI and composite index are showing the signs of at least a short-term bottom. We can allow for one more low in the S&P 500, but that would honestly look like a 5th wave down, and that would be a rally or a low in a rally to trade. So that's what I'm looking at here in the short term. And we'll see how things progress in the next week. This week with CPI, that's probably going to, on Wednesday, that's probably going to be the biggest impact in terms of a data point. for whether, the Fed and all that stuff. And when you combine that with the volatility we've seen, it's probably just going to mean more volatility, which for us is really good. All right, so that's what I'm looking at in the short term. I'll see you next week. Thank you.